Welcome to Deep Into Finance family. We appreciate you being here with us. Give us a like and subscribe to our channel. Share with your friends and family, and stay up to date to our future videos. In recent years, there have been concerns about a potential explosion in inflation, leading many people to worry about the future of their savings and investments. Inflation is a measure of the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. While a moderate level of inflation is considered healthy for an economy, a rapid increase in the cost of living can have serious consequences for individuals and society as a whole. There are several factors that are contributing to the current inflation concerns. Firstly, the unprecedented level of monetary stimulus that has been implemented by central banks around the world in response to the pandemic. This has led to an increase in the money supply, which can potentially fuel inflation. Additionally, supply chain disruptions caused by the pandemic have led to shortages of certain goods, driving up prices. Another factor that is contributing to inflation concerns is the recent sharp rise in commodity prices, particularly for oil, which is a key input in the production of many goods and services. The increased demand for commodities, combined with supply constraints, has led to a surge in prices, which is expected to have a knock-on effect on the prices of other goods and services. The economic recovery following the pandemic is also expected to put upward pressure on prices, as an increase in economic activity often leads to higher demand for goods and services, leading to higher prices. This is especially true in the case of an economy that is operating at close to full capacity, as it is more difficult for businesses to increase production to meet rising demand, leading to price increases. In addition to these factors, there are also concerns about rising inflation expectations. Inflation expectations refer to the general belief about what the rate of inflation will be in the future. When inflation expectations rise, people are more likely to anticipate price increases, leading to higher demand for goods and services and, in turn, higher prices. The potential explosion in inflation is a cause for concern for several reasons. Firstly, it can erode the purchasing power of individuals, making it more difficult for them to afford goods and services that were previously within their budget. This can lead to an increase in poverty and inequality, as those who are already struggling to make ends meet are hit the hardest by rising prices. Inflation can also have a negative impact on the value of savings, as the real value of the money in a savings account is eroded by the rate of inflation. This means that people who have saved for their future may find that their savings are not worth as much as they thought, making it more difficult for them to achieve their financial goals. Moreover, a rapid increase in inflation can also have serious consequences for the stability of the financial system. If inflation expectations rise rapidly, people may start to withdraw their money from banks, leading to a run on the banks. This, in turn, can lead to a financial crisis, as banks are unable to meet the demand for withdrawals, leading to a collapse in the financial system. In order to mitigate the risk of an inflation explosion, central banks around the world are closely monitoring the situation and are prepared to take action if necessary. For example, they may raise interest rates, which can help to reduce inflationary pressure by making borrowing more expensive, thereby reducing demand for goods and services. In conclusion, the current inflation concerns are a result of several factors, including monetary stimulus, supply chain disruptions, rising commodity prices, the economic recovery, and rising inflation expectations. The potential explosion in inflation is a cause for concern, as it can erode the purchasing power of individuals, reduce the value of savings, and have serious consequences for the stability of the financial system. Central banks are closely monitoring the